those companies, they represent the digital transformation of retail, of information, of relationships. They made fun of Facebook. When 4 billion people or 3 billion people are on a network, it's just so incredibly powerful that you can't stop the thing. These companies are now more powerful than a lot of countries, a lot of national governments. The key point I'd make is the time to buy them was when everybody laughed at you. You know, back in 2010 to 2012, most people would have laughed at you. You know, with regard to Apple, you know, they would laugh. They would say, well, you know, it's too expensive and Nokia's got the market or Motorola this or something. Or they'll never, you know, the telephone companies will control the business. Or they would say, well, the stock is too high, so you should sell the stock because here's a classic one. It was 5% of my portfolio, the stock doubled, now it's 10% of my portfolio, but my investor mandate is I never want to have any stock more than 5% of my portfolio. So every time Apple doubles, you know, the gigabrains sell half their position. And so then it doubles again, so they sell half again. So then it doubles again, so they sell half again. So then it doubles again, so they sell half again. So after 10 years, they've got a little bit of Apple stock, and they bought all of the computer companies that went bankrupt. And they did it in a risk-averse fashion. And, you know, again, the key point is diversification is selling the winner to buy the loser. And it's this common Wall Street meme or cliche, and they probably teach you in business school, and a bunch of guys in suits, they will tell you that. But all those dudes in suits that practice diversification, they didn't get rich because they diversified. They got rich because they instilled fear, uncertainty, and anxiety in a bunch of other people who then gave them their money and agreed to pay 2% management fee and give them 20% of the upside. So if you think about classic Hollywood, classic Wall Street masters of the universe, they will manage your money. You know, you're a retiree, you're a doctor, a dentist, you give them your money, you give them your life savings. They charge you 2% a year, and then they take 20% of the upside, and then they tell you that it's too dangerous for you to own Apple. It's too dangerous to own Bitcoin. It's too dangerous to own Google. You can't do that. That's irresponsible. So here's what happens next. You give them $1 million at 2 and 20. And if you actually understand statistics or financial modeling, and then you just take that $1 million and invest it in the S&P index, and the S&P were to go up 10% a year, they get 4% a year and you get the other 6%. Which means that you just gave them 40% of your money. If you ask yourself the question, who are the people telling you diversify? It's the people selling you the diversified funds, or they hold themselves out as these brilliant diversifiers. And what they're really doing is taking all your money. And on the other hand, name a billionaire that got rich by diversifying. Jeff Bezos didn't get rich by diversifying. Mark Zuckerberg didn't get rich by diversifying. Steve Ballmer didn't get rich by diversifying. You know, like Steve Jobs didn't get rich by diversifying. Elon Musk didn't get rich by diversifying, right? You could go on, you know, and like, let's take even Warren Buffett. You know the most profitable trade Warren Buffett ever made?
Apple.
He bought Apple stock. And he made more money they bought Apple stock 20 years late or whatever, and they made more money on Apple than they made on every other stock investment in the history of the company. And they made it in like 5 years. And it was concentrated position by the dominant mobile company. What happened a decade ago was the digital transformation of all those things. It was the digital transformation of information. And it created trillions and trillions of dollars of wealth. And you could have actually made a lot of money if you jumped on that wave. What you have to do is pick the winner. There's 1,000 digital retail companies. There's one Amazon. You don't want the Amazon of Singapore. You don't want the Amazon of Nigeria. You want the Amazon. You have to pick that. There's one Apple. There's one Amazon. There's one Google. There's one Facebook. If you picked it, there's one Microsoft. If you pick it, you win. You pick the number 3, you probably lose. That was a big wave. But by 2020, that was still unstoppable. Like the Magnificent Seven has been an okay investment. Like If you bought all those stocks in 2020, you probably doubled the performance of the S&P index. The S&P index is up like 45%. If you picked the best 5 companies in the index, well, you double that performance. If you picked the rest had no return. There's 493 or 490 companies that don't return anything. They're all losers. There's 5 to 10 companies that are the winners. And if you pick the winners, yeah, you do better than the index. If you pick the index, at least you brainlessly got some winners. But of course, Bitcoin outdid them by a factor of 3 or a factor of 2 to 3. Most of these companies, they don't have property, so they're valued on cash flows. And that means there's a store of value this decade. That's increasingly risky. It's probably the best conventional idea anybody has. But having the best conventional idea, it's like buying the best building in a war zone. It's like, okay, well, it's the best you could do, but you're still losing. Or it's like, it's finding the most comfortable cabin on the Titanic. The ship is sinking. You have the presidential suite. Good for you. Now, I think that's hyperbolic in this case. I don't think the Magnificent Seven are sinking, but I think that when you're stuck in a certain frame of reference, there are just various degrees of mediocre outcome. There isn't winning. In order to win or get an excellent outcome, you have to think outside the box. If you're in a war zone, you got to leave. If you're buying currencies that are denominated in a collapsing currency, whether it's a peso or a lira or a naira or whatever, you got to get out of that currency. If you're buying currency derivatives denominated in dollars, forward discounted, and the dollar is going to be inflated at 7-8% a year, well, that's your hurdle rate. You're going to have to grow your cash flows faster than 8% a year. Now, how many companies can grow their cash flows 15% a year for the next 20 years? Okay, now you might find some. Now the question is, can you protect them against politicians, foreign and domestic? If your local politicians like you, will the foreign politicians like you, or vice versa? So those kind of investments, they're very fragile, and I think you got to be aware of them. I guess that's why I did what I did a decade ago. It paid off really well, but when 2020 came, the entire world changed, and the question is, what's the next thing? Yeah, Bitcoin's the next thing, but Bitcoin is like, I've said it before, it's kind of like Apple or Google in 2010. Misunderstood. Everybody needs them. Nobody can stop them. But it's a bit better because Bitcoin is an asset class. And so its target use case is store of value for the civilization, which means that there's no reason why it doesn't subsume gold, and gold's worth 10 trillion as a store of value. Why can't it subsume real estate at 100 trillion? Why can't it subsume all store of value property, which gets you to 200, 300, 400 trillion? And the more valuable it gets, the more useful it gets, right? If Bitcoin increases in value by a factor of 100 because people buy it as a store of value, it's 100 times more valuable. Whereas if Apple stock is 100 times higher priced, the cash flows in the next 20 years have to keep up. People that criticize Bitcoin, they say, well, it's got no cash flows. Well, that's not the defect. That's the feature. It's not a liability. It's the fact that it's something that is not valued on cash flows means it's never going to miss its quarterly cash flow expectations. In fact, it's a reflection of the cash flows that have flowed into it. And so Bitcoin is just a much more powerful idea. It's the digital transformation of capital. It's not digital information, it's digital energy, right? Energy is matter, energy is capital, energy is property. Bitcoin is digital energy. Google and Apple and Amazon, they were all about digital transformation of information. I use the word energy because energy is conservative, right? It can neither be destroyed nor created. There's conservation of energy, just like capital, right? I send you $1 billion, you get the billion, I don't have the billion. I send you my photographs, you've got the photos, I've got the photos. So information is non-conservative, energy is conservative. Bitcoin represents the digital transformation of capital. That's a paradigm shift, so profound that you can say it in front of someone, and unless you have 100 hours to show them 100 examples and conduct a Socratic tutorial for them and answer their 100 questions and show them three-dimensional visualizations and then make 100 connections. If you don't have that time, they just look at you, they blank, they disagree, they misunderstand, and so they don't buy. But that's exactly what you want. You want something which can't be stopped. The fact they don't agree and they don't understand doesn't mean it's stoppable any more than I start a fire in Chicago and it's burning. It's like, you might not understand it's a fire. You might not know fire. You might wish there isn't a fire, but the fire's coming, right? It's not stoppable, right? It's a chain reaction. And this is a chain reaction right now. That's what makes it, I think, such a compelling proposition.